market signals, conflict, cycles, and the real estate market. Every time a regional conflict begins, the same questions appear in the market, which is what will happen to the real estate? Will investors leave? Or will the prices fall? Or will the system simply adjust and continue moving forward? But before exploring that question, I want to acknowledge something very important. The safety and stability we experience in the UAE is not accidental. It is the result of leadership, institutions, and the people who work every day to protect this country. And moments like this remind us of how valuable that stability truly is. Last few weeks, since the regional tension began at the end of February, many of us have experienced mixed emotions: concern, uncertainty, and sometimes simply confusion about what exactly is happening around us. For anyone who lives in Dubai or built their life here, seeing the tension near the regions is never something we enjoy. But when I think about markets, I try not to react emotionally. And my approach has been always simple. Look at the data, look at the history, look at the cycles, and try to understand where we might be inside the larger system. Over the past few years, the Dubai real estate market has experienced one of the strongest cycles in its modern history. Since 2021, many segments of the market has increased dramatically in value. In several areas, the prices increased between 60 and 80% and even higher than that. Demand surged, projects sold quickly, and optimism was everywhere. But no market in the world moves upward forever. Every system moves in cycles. When events like this happen, I often return to the concept of long-term market cycles. One historical model often mentioned is called the Benner cycle. It was first published in the 19th century. Now, you might ask, how can a chart from the 19th century tell us anything about Dubai in 2026? The real answer: because while technology changes, human psychology does not. Fear and greed move in the same rhythm today as they did 200 years ago. And according to that cycle, the year 2026 appears close to a position similar to previous peak periods. Years such as 2026, 2007 and 2000. Periods when markets were strong, prices were high, and optimism was everywhere. But what caught my attention recently was something else, which is a comparison between 2007 and 2026. 2007, the financial immunity myth. Before the global financial crisis, many people believed Dubai has a kind of immunity against any financial shock. The skyline was rising, projects were launching everywhere, confidence was extremely high. Then the crisis began in the United States, where Lehman Brothers collapsed, and the shock spread across the world, and Dubai was affected too, just like every other global market. And the myth of financial immunity suddenly disappeared. The global headlines at the time were extremely critical of Dubai. Many media narratives suggested the entire system would collapse, and we're witnessing a similar wave of dramatic headlines today. But of course, there is a massive difference between 2007 and today, where in 2007 the market was fueled by cheap debt. However, today more than 70% of the transactions completed in cash, and equity is the ultimate hedge against crisis. However, today we may be witnessing a different psychological shift. For many years, people developed another idea about Dubai and UAE, that it was completely insulated from regional instability. And to be fair, Dubai, Abu Dhabi and other Emirates has consistently ranked among the safest cities in the world. But we must remember something important, that the UAE is not located on another planet, and it exists in the same global system as every other country. Therefore, financial crisis, regional tensions, global shocks, and other major events, these events affect everyone. And the real difference is not whether a country faces challenges. The difference is how it responds to them. And historically, UAE has responded better than most. So what will happen to the market now? There are actually three possibility paths. Scenario 1, tension fades. If the tension cools down in the coming weeks, the markets will likely stabilize. But of course, confidence does not return overnight. The psychological and economical effect of events like this does not disappear overnight. Instead, they can linear for months, sometimes even years. In that case, the market may experience cooling phase, similar to the period between 2015 and 2020. Scenario 2, tension escalate. If tension continues for months and begin to affect global trade and the world economy, then the downturn will not be local, and it would likely be global, similar to other international recession cycles, including the period that followed the 2008 financial crisis. But there is also a third possibility. Capital is like water. It flows to the point of least resistance. And And when the world becomes more violent, capital searches for stability. And historically, the UAE has often benefited from that shift. And in that scenario, Dubai may not simply survive. Instead, it may become a global lifeboat for wealth. Another important point about markets is timing. Many people are currently looking at transactions numbers from early and mid-March, and some are using these numbers to suggest that the market has not been affected. But the real estate data does not work that way. Between the moment a deal is agreed and the moment that transaction appears in Dubai Land Department system, there is usually a delay. And the process takes several weeks. SPA preparation, check processing, trustee registration, verification, and finally publication in the official data. And this process often takes several weeks, which means many transactions announced in March were actually agreed in February, before the current tension began. A real estate market reaction will likely start appearing in the data around mid-April and the weeks that follow. Every market cycles affect participants differently. The group most exposed is usually short-term speculation. Those are investors who entered in the market expecting to flip quickly before the completion, and often relying on highly leveraged positions or flexible payment plan. Yes, those strategies working well during rising markets, but they become fragile when momentum slows. On the other hand, long-term investors are in different position. Investors who bought assets as they comfortably holding it for 5, 7, or 10 years. For them, cycles are simply part of the journey. Cycles also create something else, which is opportunity. When markets cool, developers become more flexible. Payment structure improve. Negotiations return. And opportunities begin to reappear for buyers who previously felt that the market become too hot. And periods like this also tend to trigger familiar economical response. When uncertainty rises, governments often inject liquidity to stabilize the system. And over time, that liquidity leads to inflation. And when inflation begins to rise, capital historically moves toward hard assets: gold, silver, real estate, and others. Not because they are perfect, but because they are finite. Which is why periods like this often mark as the reopening of buyer's window. If you are worried about the market, ask yourself one simple question. If the prices dropped 20 or 30% tomorrow, can you still afford to hold that asset for 5, 7, 10 years or more? If the answer is yes, then you are not gambling, you are investing. Cities are long stories, and they are not written in single year. In fact, they are written over decades and centuries, through expansions, through corrections, and through moments of uncertainty, like this one. And markets behave the same way. Every mature market in the world have passed through cycles, through recessions, through financial crisis, and sometimes through wars and geopolitical conflicts. And the real challenge is not the existence of those events. The real challenge is learning how to navigate through them. Because throughout history, many of the greatest opportunities have appeared during the period of uncertainty. And in many ways, this moment may be simply another milestone in the long maturation of UAE real estate market. And through the Archi lens, we are not trying to predict the weather. Instead, we try to understand the seasons. And we do not fear the cycle. We study it, we analyze it. Because in a market full of speculators and noise, the advantage belongs to those with vision.